Welcome to the Foundation for the Study of Cycles. This is a special episode today. Thanks for joining us this Saturday live here in this session. Today we will talk about our new Cycles magazine, what you see here in the background. So the Cycles magazine was brought back to life from the Foundation. It has been a long-running magazine and journal, but was not published for about, I would say, 20 years. And based on our new rebirth of the Foundation, we have managed to bring the Cycles magazine back. And especially two of my board colleagues are managing the magazine and working as key editors to that. And therefore today we will have the chance to discuss in this group here about the current magazine, which is now brought to you. So therefore this session we will have two guests here in the show. So welcome Bill Sarubbi, which is here on the one side of the screen, and welcome Andy Pancholi. So welcome to the show. So both are my colleagues in the board of the Foundation. So Bill Sarubbi is acting as investment manager and cycle analyst for, I don't know, a lifetime, I would say. So he's an expert in all these financial cycles and teaching and managing funds on that side. So happy to have Bill on the board, on the Foundation. Bill was a long-time member also of the board in the early years. Similar to Andy Pancholi, he's maybe one of the best knowing about all these long-time historical cycles. I mean, when Andy talks about historical cycles, we all get quiet and just listen to him about his knowledge on these cycles. So Andy is also part of the board of the Foundation for the Study of Cycles. And both are the key editors of the new magazine. So first of all, thanks Bill and thanks Andy for bringing back this great magazine.
Oh, you're welcome.
You're welcome.
How are you? All fine?
Great.
Yeah, okay. So for today, what we are running, we will run about 30 minutes, 30 to 45 minutes. We will have also a look at the chat section. So feel free to raise your questions, bring in your questions when we start to talk about the magazine. This is a live session, so we always aim to bring your questions here then into the forum and discuss them live. So if we get back to the magazine, so I hope all of you have already read the magazine, which is available on our website. But if we go through it, and let's have a first look at this magazine now. So I think, and I will bring you in, the first topic, if we just browse the content, yeah, and let's have a look at the content. So the first three articles are around one topic. Yeah, so even though these are three articles, it's about the stock prices in space, which is an original article written by Dewey, and we decided to reprint and republish this. The second article, Stock Prices, Mercury and Space, is, I think, an addition which Dewey then added some content to his original research back in 1969. And then Bill took all these content and knowledge and updated it up to today. So I think you added about 50 years then from the data set, which Dewey had not in mind. So it's interesting now that we have on the one hand side the original content from Dewey and can now add around 50 years of data on that topic here. So before we dive into this first section, so Bill, what was the reason to choose this content from Dewey for a reprint?
Well, it's because I got out of graduate school at NYU in 1972. And of course, after 5 years of studying finance, nobody at the university knew what made stock prices move either. And so I found out about the foundation, I joined, and I read this article. And there was a well-known seasonal cycle in stocks that it rallies in the spring, tops in the summer. September usually weak. October there are more lows, and Q4 is the strongest quarter. That's derived from a calendar. A calendar is derived from the relative position of the sun and the earth. And so I got that immediately. It's an elliptical cycle. And I wondered if anybody had done any work with it, and Ed Dewey had. His article states that the conjunction of the planets Sun and Mercury, which this is, by the way, geocentric, which means it's taking the sun as the center, the Earth as the center, and letting the planets revolve around it, as opposed to heliocentric, which is a different system. And every time the sun is 0 degrees from Mercury in what he called the 10th sector, the stock market had risen up until he wrote this in 69, 89% of the time from 21 days prior to the conjunction to the day of the conjunction. So that was rather startling. And let me add that the 10th sector meant the astrological sign of Capricorn, but he didn't want to say that. And this can only occur between approximately December 20th and January 19th every year. And some detractors might say, well, the market is strong at that time anyway. Yes, but it is much stronger if you have a Sun-Mercury conjunction in Capricorn. The last one was January 7th, 2023. The market rose in 5.2% in
Yeah,
the 21 days prior. Yes.
Thanks. Let's get back maybe to some basic content, or to bring the our members in, which are not experts in these space and planetary movements. So could you explain maybe first in simple words what is a conjunction?
That means they are 0 degrees apart, or they're in the same place in space.
Okay. So why is planetary movement interesting in regards to cycle analysis? So if we have a conjunction, what you explained, so they have cyclical movements, the planets, and that's the reason why we take it into account just as a primer to get this started for the newcomer into planetary movements.
Okay, so I'm sorry, what is the question?
Why are planetary movements interesting in regards to cycle analysis, or what's the relation?
As I explained, there is a very definite seasonal cycle in the stock market. I lectured twice at MIT, and I said, does everyone here believe there's a seasonal stock tendency in the stock market? And about 80% of the people raised their hands. And then I pointed out that a calendar is derived from the relative position of the sun and the earth, which made a lot of them look very sour. This implies that there is some energy emanating from this cycle that is affecting human behavior.
Mm-hmm. Okay, so why did Dewey pick these planets in this article? So was there a reason for him?
I don't know why he picked those, but back in college in the 30s, his roommate was hunting in Hartford, and from the story that I heard, that he demonstrated to his college roommate that planets seem to have an effect on industry, history, and stock prices. So this is an idea he came up with in the 30s.
Okay. So, and I think you mentioned this already, but in this article, we have lots of these tables reprinted here. And I think also Dewey mentioned this tenth segment, yeah, which is special if you look at the numbers and the percentage of findings. And this is what Dewey also highlights, that the 10th segment is interesting. What are these segments about? So can you explain what is segment 1, 2, 3, 4, up to 12?
Well, they're just, if you take the sun's plane, which is called the ecliptic, and you divide it into 12 equal slices, you get 12 sectors. He called them sectors. Astrologists would call them signs. The 10th sector was the sign of Capricorn, and it extends from approximately December 20th to January 19th, a period when the stock market is usually strong anyway. But it is much stronger if you have a Sun-Mercury conjunction in Capricorn. And I also extend, and when folks have time to read it, that Sun-Mercury conjunctions in Virgo, which usually occur, it's August to September, usually coincide with tops. And in Scorpio, which would now be the 8th sector, that can only fall in late October, early November. That usually, as you might imagine, coincides with lows. But if you know these things, you have an added degree of assurance over someone who's just looking at a plain seasonal cycle. That's the value added from the cycle.
Okay. So and this 10th segment is then related to the Capricorn, which is then the name for this segment. I mean, just for the beginners who might not be aware.
Astrology name.
Yeah. Okay. Thanks. Yeah. And I think this is where Dewey's work ended in, I think, 1969. And you took this same work from Dewey, and you extended this work for the next 50 years, I think, up to today. So have you been able to confirm the findings from Dewey in these 50 years Dewey could not be aware of? Yeah?
Yeah, advance it one more page, please.
Yeah, sure.
Yes, down in the lower left, that is Sun 0 to Mercury in the sign of Capricorn, and that is from approximately, I think it's 1885 to the present. So his work was, I think, 1885 to 1969 or 1915 to 1969. When I first developed software in 1986 in my office at Payne Rubber back in New York in the old days, I tested this out. It was 89% accurate. In other words, from 21 days before this 0 degree separation to that day, the market had been up. The Dow was up 89% of the time. It's been as low as 84 over the last years, and it's been as high. Right now, it's running at around 86. And as I said, the last one was January 2nd, 2020, and the market rose 5.2% in the 21 days before that versus 1.3% for the month as a whole. So you see the value added. And the next one, which everybody's probably wondering about, is January 7th, 2023. That's 1/7/2023, and December 22nd, 2023. But the second one is occurring very early in the cycle. It is the January 7th one, 2023, and then January 1, 2027. So you see they occur about every 3 years, Lars.
Yeah. So I mean that's great. So you also have confirmed the findings from Dewey that they continued to work out. Yeah, exactly. And we have now labeled the next dates. I mean that's very interesting. I think at least for the ones who are looking, okay, what can I take out of this? So the dates are already in the magazine, so they don't need to look up into their own list of when the next conjunction takes place. You have already listed it there. Okay, thanks. Yeah, great. I think a great takeaway, at least to continue or to reevaluate Dewey's work here and to bring this also to our members here. I think you also extended it a little bit the research on this on these movements, and I think what have you found in addition to Dewey's work, what you mentioned in your article a little bit?
Well, yeah, I touched on it. Sectors 6 and sectors 8, which would be the astrological signs Virgo and Scorpio. Sector 6 can only occur August 20th to about September 19th, and it is, as you know, most stock market, the average high in any year is September 5th. And so if you get one of these Sun Mercury conjunctions in Virgo in late August or in early September, the odds of it being a high are much greater. So there's value added by knowing that. If you take the 8th sector, which is the sign of Scorpio, which only can occur between approximately October 20th, November 19th, if that occurs in late October, early November, then you have a much greater assurance of a low. So I'm trying to point out that, Ed Dewey, they didn't have computers in those days and software like we do. So this work can be greatly extended.
Yeah.
And I'd like to add, the next article we have from my friend Theo Modis in Switzerland also comes to the conclusion that the cycles are related to solar radiations, to the solar cycle, sunspot cycle.
Yeah. Okay. Yeah, that's an interesting work, and I would expect that we will see anyhow additional topics on solar cycles, geomagnetic cycles, and how the planets influence these movements for our life here on Earth. But maybe that's something for another magazine. So yeah, thanks, Bill, for summarizing and bringing this back in front of us all on this topic here. And I would say then one of the next articles, if we then continue within the magazine, let's just quickly have a view on the next key article, which was then shown, is
Yeah,
about,
I'd like
yeah.
to make some comments on this. Yes.
Yeah, exactly. So, but just, feel free. I mean, this is about, or before you start with your comments, Bill, this is about the Kondratieff. I even don't know how the name is spelled correctly. I mean, please help me.
Oh,
Kondratieff's
that's right.
economic cycle. I think this is the 56-year cycle, which is, I think, well known in research and economic cycle research and science topics, and I think this cycle is discussed very often in studies and magazines. But that's the question. So why has this cycle been now revised with this article in the magazine? Because I think this was a very old finding, and now what's the key of this article here, Bill?
I'll tell you what I think is very important. Professor Theo Modis is a professor, and he's using an academic approach. I met him in Vienna, and if anybody is interested in if you don't know anything about cycles, I recommend his books, Predictions 10 years later, and Predictions 20 years later, which is also called an S-curved adventure. He's brave enough to look back at his own predictions from his prior books, and so here he takes this is how an academic looks at Kondratieff. A lot of people just take a ruler and they put it, they measure out 54 years usually. Here, quantitatively, he says it comes to 56 years, but he also says it has poor quantitative confidence levels. In other words, there's a great deal of variability. And that number one, he's an academic. Number two, he's measuring it at 56 years. And number three, he says it's got poor confidence levels. So, which I understand. It's not exacting, but I appreciate very much an academic looking at it. And then what do you relate it to? And he relates it to energy consumption. There are if you look through Dewey's catalog, there are a whole flock of 56-year cycles. And this is an important point. Energy consumption, I think, is very basic, because if human beings want to act positively on resources and build things because the innovative urge is there, I think energy consumption is a good place to start. And he also relates it to bank failures, homicides. There's a 56-year cycle in hurricane sunspot activities, price indices, and technological innovation. So let me just say, if some of these, what is the core cycle? I think it's human ingenuity. Therefore, they will consume energy, and that will change the price index. If they start manufacturing things, much more cheaply, or if it brings inflation, the price level will follow on. So I don't think the price level is the key. I think he's got it right here in focusing on energy consumption, because that's a reflection of human activity and endeavors.
Yeah,
And bank failures. Yeah.
But because we look currently exactly at this energy chart here, which I've just brought up, can you just quickly explain what is shown here in this chart?
Well, that is the 56-year cycle in energy consumption of energy, and that's both fossil fuels and electrical energy.
So the gray cycle is the theoretical bandwidth, yeah, where it and the points here is which are the
actual numbers.
The actual numbers, and we can visually see that even the measurements are more or less exactly within the bandwidth of this. And I think it's the 56-year cycle which is used here.
Yes.
Yeah. Okay. So but why is there still critics on the cycle if we see such kind of picture? I mean, I think this is a clear proof that the energy consumptions works against the 56-year cycle. Or not? So there's not enough proof in that, or enough data sets used, or what is the criticism which is still against that if these examples are shown here from a scientific approach?
Well, Theo, I think, addressed that right up front. He said there are poor quantitative confidence levels. In other words, it averages out to 56 years, but it can be short, it can be long. And my observation is that inflation of the currency, which is just rife now, distorts these cycles.
Okay, so this is maybe what we see here in the upper front. I think this is the bank failures, no, where we have a long flat period and then an abrupt jump. So it's not a smooth cycle, which is coming from top to low in a smooth cyclic fashion. It jumps then, and if you average it, it fits into the 56 years cycle, but it's not moving as smooth as a theoretical sine wave cycle, right?
Yes.
Okay, and I think that's then the complexity of this Kondratieff cycle, which is maybe finally not solved, but so you can find it on average in different data sets, which is used here then in this article, but still the confidence level might be claimed if you want to fit it into the curve. Okay. So we have. So I think what's the takeaway of this article? It's maybe around that a confirmation that the Kondratieff cycle, which was found and discussed, I think years ago. I don't know when the original cycle was published first time, but this is then a scientific approach then to prove it's still there. It can be measured because I think it's an economic cycle. No? So you can see it in bank failures, you can see it in power consumption. So it's a kind of a proof from a scientific perspective that it's still valid up to today, right? Oh?
Yes. Well, as I said,
Okay.
it's good to have an academic. Academia usually doesn't put much stock in this. To have him take a look at it from his viewpoint
Yeah.
and just say right up front, there's poor confidence levels, there's a great deal of variability, but let's look at it anyway and see if we can get anything valuable out of it. And I think, Lars and Andy, and I think you'll agree with me, that it's more of a cycle in human ingenuity and innovation. There have been long periods of history where I've visited countries in Africa where people there's no entrepreneurial spirit. People don't want to do anything. And other countries, like if you've ever been to Hong Kong and Thailand, where the people are busy beavers, working. And I think that it runs in a cycle. And I believe he's correct to link it to the sunspot activity. And so that's why you get the reflections in energy consumption, because if you start using energy to build something and make something, and then the economy runs up too fast, too much money is extended, there's the inflation distortion, and then you get bank failures when it turns down because they're overextended. And homicides, I don't know. That may just directly linked to sunspots. Hurricanes, don't think it's a separate weather cycle. But there were a lot of subsidiary cycles, like if the automobile is invented and takes off, well, of course, the demand for rubber and anything that goes into a car will go with it. What is the basis? There's not a rubber price cycle. There's an innovation that led to the automobile, that led for the demand for all the materials that go into the automobile.
And
so
I mean,
my takeaway.
You mentioned these influence on our human behavior. I think, wasn't it in the article that it said the 56 years is the period which an individual human can influence, I don't know, economic behavior. So this is the average period of every one of us, which is able to impact during his lifespan. So maybe that's also an interesting cycle. I don't know. I think it was mentioned in this article.
I think that's a good way to look at it, Lars.
Yeah. Okay. Yeah, thanks. So interesting again to bring back a kind of cycle, refresh it from a scientific perspective, and bring all these great examples here in on top. So okay, let's have a look at the magazine back again. So I think we have much more in, and I think even we will now take a look at much more longer cycles. So to also bring you in, Andy. So you wrote about forecasting long-term market cycles, and I think now we are coming to the 90 years and 100-year cycle where you're writing about. But first, maybe tell a little bit how have you researched these long and super long-term cycles about these 90 and 100-year cycles? How have you discovered these cycles?
Okay, well, thank you, Lars. So the research has been going on for a long while, and those of you who know me know that I've studied a lot of the work of W.D. Gann, where he's very cryptic, and some of these cycles are becoming evident from there. And as I was looking at those cycles, that's when For example, he hides things openly, like he has a book called 45 Years Wall Street, So that, you got to look at these clues, but then you double it up and you see that the 90-year cycle is a very prevalent one, and it repeats in the commodity markets, in the stock markets, and so on. And perhaps we can just turn over the page there, Lars. And if we look at that on the top left-hand side, we find the stock market crashes in the 90-year cycles there. We find, everybody's familiar with 1929. And so we thought, the way to research this was to see what happened 90 years before that. And 90 years before that, we would take us to 1839. We got this massive collapse from 1837 to 42. So it seemed logical that we could probably progress this forward. And that's how we identified 2019 to 2020, which, brought the high end then last March. But then taking the smaller harmonics of this, let's just head back from where we are now, or forward from 1929 to 1974. And what happened there was the OPEC oil crisis. The Western world was brought to its knees. The price of oil went racing up. We went into recession and depression. But then I thought, well, what happened in 1884? And again, we had a smaller panic there. But nevertheless, it happened. And it was in the middle of a depression. It was unusual because it didn't trigger the depression. It was actually partway through it. And in 1884, two critical things happened in terms of the financial markets. There were other issues in the commodity markets, but in 1884, a stock brokerage called Grant and Ward. Now, Grant was the son of Ulysses S. Grant, the former president of the United States. They had a brokerage, and that went bankrupt in New York. And at the same time, there was a guy called John Chester Eo, who managed to embezzle $3 million from the Second National Bank. And so there was this huge crisis confidence. So it was a short, sharp crash there. So just seeing these repeat is pretty interesting. But, it doesn't just repeat there in markets. It's very strong in the commodity markets, by the way. It's also relevant in human events and geopolitics. And what always amused me and followers of my work now, I wrote about this, but the very day, I live in England, for those of you that don't know me, the very day we voted on the Brexit referendum was 45 years to the day that the French government finally gave up and said, yes, we'll let the Brits into the common market. They were the biggest opponents to Britain having anything to do with the European Economic Union, as it was called. So that was the vote. And of course, lo and behold, we voted to get out. But you can go back another 45 years, all the way back there, and you'll find at the same time, Spain left the League of Nations in protest at the dominance of Germany. So, the theme is the same. Germany is a dominant nation in the League of Nations in what was going on in terms of some of the decision making. I know it's more complicated than that. And then you come back to, when we did Brexit in 2016, that the same issues were coming up. So this repeats, and I think it's a very interesting cycle. I think it's like 1.5 generation cycles. So that's kind of like the 90-year cycle. But what I thought was interesting about the 100-year cycle was that we got the 1907 rich man's. There you go, you got perfect. The 1907 rich man's panic. And then if you head forward to 100 years and you get the 2007 global financial crisis, and look at the 1907 rich man's panic. That was a pretty big sell-off. It looked like an 80% correction. But you could go all the way back to 1807 to the Embargo Act, and that was when America basically brought this law in to prevent trade, to try and influence and intervene in the Napoleonic Wars. But again, that backfired, creating a huge economic downturn. And, 1707 also had these sort of things going on. So, it's kind of evident that these things sort of occur in 100-year cycles. And, of course, you take the midpoints from these. And
And I just wait. I mean, it's always impressive if you speak about these long-term cycles, and you're rushing in such a speed around these 100 years.
Sorry, so I get very excited about these.
I just need to. But I think the good point here is it's now written in this articles here, so we can read it on our own speed here. So I think, and this is But no, thanks for just pointing it out, because I think it's important to review. I mean, it's a very compressed article, but I think there are very important dates and cycles you mentioned, and you just rush over it. But maybe let's pause for a second on, you use the half span of the larger cycle always. So and in regards to cycle analysis, we often call this the harmonic of a cycle. No, if we use the half span or force of the cycle. Why do you think this is important, or in your observation, is this often useful to use also the half span, or you first discovered the full term cycle and then you looked at the half span, or how did you use this kind of harmonics?
Yeah, so in my research, I've taken points, major points. So you want to pick clear events, right? Really clear events, and then you want to take the harmonic. So the two main points will be the key points of it, and they'll be the big events. But if you take the halfway point, then we have to presume there's going to be some sort of event. It might be lesser there, and I know a lot of you trade markets. This isn't just about markets, this magazine, but we look about 50% retracements, don't we, and how they hold. So there is a natural progression of mathematics in nature and so on that leads to this sort of idea. And then the really interesting thing is where all the harmonics come together, where you get different cycles meeting at the same point in time, and different harmonics. And I think that's really what this is about.
And maybe just, if I think you pointed out that 2019, 2020 are the key years, no, which are now coming in alignment with these half span cycle, 90-year cycle and 100-year cycle. Do you think we are through all of this chaos right now, and now we will see, or aren't we through this situation? I mean, you can't time it on the day with these long-term cycles, but do you think that?
Time things to the day, because you take different harmonics and you can break these things down. I actually do, and we've done that several times. And that's what we aim to do. In answer to the first part of your question, is it all over? No, it's not all over, because if we were just to take a linear overlay from the 3rd of September 1929 and add 90 years, so our equal high was mid-February, so we're in the anniversary of that right now at the time we're going out. Okay, so it's slightly out by 6-7 weeks, or whatever we want to call it. 6 weeks in plus 3, plus the balance of the 1929 segment. But the low came in July 1932. So we would probably want to project forward 90 years from 1932 anyway. But what else also happened in that time was that 1931 to 1934 saw countries coming off the gold standard. All right. So what does that mean now? That means we're probably going to see some sort of issues with currencies over the next few years. And we're already seeing these very big currency moves this last few weeks and months. So this is tying in. And Bitcoin is similar as well. We talked about sorry, I'll slow down. I can tell. We talked about the 100-year cycle. 1720 had the South Sea bubble and the Mississippi land crisis. These were bubbles, right? So we did expect a big bubble in 2020. We wrote about it. We warned people at the end of 2019 there's going to be a bubble, and I think that really is the cryptocurrency bubble coming in. So there we have your 100-year cycle. Is this, or what was this a different cycle length? That's 3 times 100-year cycles. So
okay, okay, but then. Yeah. That's another harmonic. It's another harmonic of the 100-year cycle then.
Yeah, and just geopolitically, Battle of Waterloo was, the Napoleonic Wars ended 1814, 1815. 1914, we get the outbreak of the First World War, right? And then if you look back, the second decade of every century seems to hold some significant conflict. Go all the way back to 1415. We have the Battle of Agincourt. And they kind of follow these patterns. I don't know why it works, but it's pretty interesting. So
I think
that's a quick overview on the long-term cycles. But I think the next article is from Michel Jacquemin, right, from our friend Michel in Switzerland. And he raises a really interesting point. And I think this is going to be really interesting because I want to tie it in with some other things that we've already spoken about that you and Bill were speaking about. So perhaps we can just page forward. And what we see here is that if we look at the bottom left, he says every 9.3 years, he sees some sort of pandemic. And then if we can zoom back out again, see the other page at the same time. Okay. We see that he has created this this graph of potential epidemics or whatever, pandemics. And if we double this 9.3 year cycle, we get 18.6, right? And if we take 18.6 and we multiply that by 3, we then are going to get back into our 55-year cycle approximately. It's going to be around about 55 and a half, 56 years. And this ties up with the Kondratieff wave that Nikolai Kondratieff discussed. So also, Michel's exposition here is very good. And I think it's fabulous that it really he's done a lot more research here. We also looked, and he references how it tied back to the 1918 Spanish flu. In the first re-release edition, the first edition, we looked at 100-year cycles in pandemics, and we'll find that 1918 had the Spanish flu, 1818 had, I think, the first cholera epidemic, 1718 was smallpox, as was 1618. And you can add the 50-year cycles to each of these, and you'll see significant. So if you go to 1618 and add 50 years, it takes us to around about 1668. Well, 1665 onwards was the plague in England and all around Europe. So these again tie in, and what we're seeing. So we talked about the super long-term cycles and how we can hone them down to smaller, even individual days. By taking this 9.3 year cycle, we're able to hone in from the bigger cycles, if that makes sense. And Michel mentions this. I think he says 11 9.3 cycles, come out to just over 102, 103 years. So this is the same concept of being able to use this stuff for forecasting.
So Andy, I think this refers then back to this harmonic topic, no? So you use the 9.3, multiply it by 2. This is the 18.6, and then you explained how you come back to the 54, 56 years, which is the Kondratieff cycle, and then you can multiply another harmonic, and then we are back to your 90 and 100 year cycle, right?
That's it, yeah. And there are several, and we look at how all these waves dance together, and that's how we fine-tune things. And I think this is very key. And what's really interesting is that Michel's article there ties in exactly what you were talking about in the Kondratieff wave as well. But if we just take this double 9.3 year cycle and use it at 18.6 years, this is a generational cycle. So 3 generation cycles take us into the Kondratieff wave, all right? So if you take the first generation, they will develop something, the next generation will do something. But after 3 generations, nobody's alive to say, let's not go to war or let's not do this. The whole cycle begins again at this point, in my opinion. And that's exactly what Theo Modus is saying with the energy. There's another huge reset, but there are harmonics within that. And I think that's what's becoming very evident there. So I think this is significantly important.
So it looks like the articles are interconnected with each other if we talk about the harmonics of these cycles. So
absolutely.
Yeah, thanks, guys. I know that's
Lars,
the reason. Bill.
Can I just run back to issue 1, where I wrote an article about my old friend George Lindsay?
Please.
And he wrote about cycles from the mid 30 years up to about 40. But you said, why does this occur? And George would say, well, there's a concentration of feeling in art, literature, or whatever at a certain time, and it may not be complete. So you may 36 or 38 years later get a renaissance or another revival. It's built up in human emotion. And I remember when the AIDS epidemic broke out, I lived in Greenwich Village in New York, which is a gay area. And the AIDS epidemic hit, and then as it progressed, I said, how is it going here in the gay community? And he says, well, it is the infection rates are slowing down because we altered our behavior. And I think the
Hmm.
turns in these cycles are alterations of behavior.
Mm.
Like when if
Mm.
gold goes to
Mm.
$5,000 an ounce, people are going to say, wait a minute, $5,000 an ounce. Do I want to buy any here? And then
Mm.
it starts cascading down. It's the same with real estate or anything else. So that is what I have derived. That's what these cycles mean.
Mm. Yeah, and then it's really interesting to get the harmonics to nail it down. What you tell us, even to the day or the months, if we take harmonics and maybe other cycles. That very interesting. Yeah, thanks, and a great read. I mean, all what we talk about here is just written in this journal here, so would be very interesting to go through it. Okay, yeah, thanks. I think what's still missing in this magazine? What else do we have?
So, do we want to talk about the butterfly pattern, or Bill, you want to talk about that, or Lars? You've written a splendid article. Shall I ask you some questions on that?
Yes, let's turn to Lars.
Okay.
Yes,
So,
please.
Lars, let's bring your article up then.
We will do.
So I think most people, well, maybe people don't know. Lars is a board member of the foundation, and he really specializes in data signal processing. He is the brains behind the application that's available for members, and it's incredibly useful. In fact, after we relaunched the foundation, we put it out there as part of the package for members. I got a call from a significant portfolio manager at one of the world's largest hedge funds saying, "Are you guys really giving this away for $99? We spent millions and we didn't even get close to this." So well done. So let's bring your article up on skew analysis and so on. So
Yeah, thanks,
yeah.
Andy.
So what is an asymmetric cycle?
Yeah, thanks for asking. Yeah, and I think now it's getting back to more shorter term cycles. The asymmetric business cycle means, or let's take a step back. Normally, if we talk about cycles, we always have a symmetric cycle in mind, which means also if we look at the article where the Kondratieff cycle bandwidth was shown with the standard sine wave cycle moving up and down. And symmetric means the time you need to rise to the top has the same length as it needs to get down to the bottom. So it's symmetric. Yeah, it's the same length rising to the top, the same length rising to the bottom. This is the standard symmetric cyclic behavior we in most cases use, or even and this gets back then to the application or digital signal processing topic, which you mentioned. If we use then mathematical routines to do projection or correlations based on cycles, we often use standard symmetric cycle function, which is the sine wave or other mathematical functions, which always use this symmetric behavior. And this was not my finding, but if we look just at the last 30 years of the economic and business cyclic behavior in let's say, in what the last two generations could be influenced. If we look at the last Kondratieff cycle or last 30 years, scientific research shows, and this is not my own research, this is well documented in scientific research, just analyzing the last 30 years of financial economic cycles, that we don't see this symmetric behavior anymore. Because and what happens during the last 20, 30 years is that the downturns or the economic shocks happen more quickly and are more sharp. So the time span for downturns has become very, very small, while then the period on the other side of the cycle, so then the boom phase or the period then rising to the top, has become much longer than the period it takes to get down. So, and this means we don't have this symmetric cycle anymore in the markets.
Right, and that's why it's important, is it? Yeah.
Yeah, exactly. So that's why we need something. If this has been researched by a lot of scientific colleagues out there, and there are a lot of articles about that. But if we then still use symmetric functions, standard sine waves and whatever, this will lead to failure, because the markets don't behave in this symmetric way anymore. Not talking about this long-term perspective, but if we look then into kind of 2 year, 3 years or 5 year cycles, they are not symmetric. So we should not use symmetric functions if we do projections anymore. That's why the asymmetric topic is very important. And there are not much functions out there. And I mean, you have introduced, I'm more looking at it from the digital signal processing. So this article is then more about, okay, what can we do in regards to the functions if we want to apply digital signal processing, if we want to plot cycles into the future. And that's what's mainly then this article is about, where, maybe we can have a look at one example here if you want to like. And this is just, So what you see here is just the a standard symmetric cycle with 175 days plotted on top of the S&P 500 index. And you see here, and the it's not important here, but the light blue is out of sample, while the dark blue was in sample. And the projection here, so the top was predicted too early, in this case here, while the bottom then was projected too late. And that's exactly the asymmetric behavior you see in real life. So the boom phase will take longer than the standard symmetric one, while the bottom will come in more early, and then the next upswing will take again longer. So, and if you then apply some kind of asymmetric function, which is here the second chart outlined, it's the same cycle of 175 days. It's just used with the skew factor is then just the mathematical way how to do it in a routine. But you see the same cycle, the cycle length has not been altered. It's the same 175-day cycle, just with these asymmetric skew now introduced. And you see now the projected top and the projected bottom comes much more in alignment with the real market behavior. And it's just an example here, but that shows why it is important to not only have a look at this standard symmetric cycles here. And I think that's any cycle analysis needs to take this into practice, because if you use cycle functions from whatever tool sets, I think in over 90% of each case, they still use symmetric calculations. And if you do short-term analysis, this might not be the best way. And I've just shown some mathematical functions here. Then if you want to bring this into your own calculations, I've just shared the routine. It's a kind of drop-in replacement, so you can throw away the sine wave function and you can push in this mathematical function, and then you can keep your old routines. But that's mainly it.
Right. Well, I just want to bring Bill in if I can. Can we bring Bill back up? And
Sure.
Bill, I'm going to put you on the spot. I have to say that, look, Bill and I have been friends for a long time, must be approaching 30 years. But Bill, you told me a story of why markets go up slowly and come down quick. And you quoted, was it Frankie Joe or somebody who?
Yeah, I said, Frankie, how come you make first of all, Frankie was a Chinese orphan. He came to New York. He's working on the floor. And he started with $600, and he started a newsletter to show us all how to do it, and it failed. So he started trading. In 15 years, he made for himself in interstate securities $32 million. He was up at one point 15 consecutive years. Some of those years were like 200 to 400%. And I said, Frankie, why do you make money going short? And he says, well, Billy, he had a very low voice. Well, Bill, it's quite simple. If you walk to the top of the Empire State Building, it takes about 2.5 hours to get to the top. If you jump off, it only takes a minute or two to get to the bottom. And Frankie used to yell at me, and he said, if I complained, he said, Billy, do you have more than $600? And I said, yes, I do, Frankie. He said, then you were in much better shape than me when I started.
So there we go. I just thought it'd be fun to hear that story. I love that story.
Yeah.
By the way, I just want to mention, we also have an article by my friend Edward, and a friend of yours also, Lars, in Moscow, about combining, technical and cyclical work, which is, I also wanted to we didn't discuss it, but I wanted to mention that's also a very valuable article. And there's one very important cycle. It's on the last page, and that is the cycle of membership, which is about to go straight up. So everyone up there, you should get in on the ground floor and sign up now before the cycle peaks.
And the cycle will peak end of February. So I think thanks, Bill, for bringing this up. Yeah, I mean, it's a good, more or less final statement here, I would say. I think we took a long time. So I think we are running now for over 45 minutes, and we just wanted to highlight some key articles here. So
let's just talk about the membership. Can we go back to the introduction where our chairman and CEO has shown what we're trying to do, and not trying to do, but what we've already achieved. And I think it would be worth just highlighting this to everybody watching, and what we're trying to achieve, really. Basically, Dr. Richard Smith has put a significant amount of time and money in to get the operation going again. And, we have the new board that you're already familiar with, but most importantly, we have the app there. There's a picture of Richard, but the app, which is very, very powerful indeed. And we've had a couple of summits, 2 financial summits and a science summit. Most importantly, we are a 501c3. We're a not-for-profit, and we're all volunteers. And we're looking to build this out and basically show how cycles can be harnessed for the good of humanity. And I think, right now, we've got the magazine coming back, back out again. This is the 2nd edition. That's why we're here. We've just celebrated the 80th anniversary. And, for $99 a year, just till the end of this month, it's just fantastic. Look at the names that have, of the people that have spoken in our summits. We've had some fabulously well-known names: Larry Williams, Jeffrey Hirsch, Peter Eliades, Jake Bernstein, our own Jake Bernstein. Jack Schwager came along last time. Bob Proctor, our very own Bill Sarubbi, has spoken. So, come and join us, support us. It's a foundation. It's a charitable foundation, and we're out to really get it out there. So anything you can do, join us now, make a donation. That's it. And we're looking forward to taking this to levels it's never been to before. And we really do want to help the world out with this.
Andy, Bill, thanks for this statement. Thanks for having this conversation on the magazine. It was just always fun to have this chat on these great knowledge on long-term cycles and bringing it into practice. I think we will have lots to come if we look into the future, what you mentioned, Andy. So happy to continue this year. I've seen, by the way, in the chat, the discussion about long-term cycles just continued parallel in the chat section. So I think it's they took it up and just put harmonics on it when the next cycles took place. So thanks for even continuing the discussion here in the chat section. We will see you at the foundation for whatever knowledge and reason. Thanks for joining us here in this session. Feel free to drop your comments and questions below this video. We will be here and comment your questions even though below the video. So feel free to drop it. We will review it. Thanks for taking the time with us this Saturday, and we will see you all at the foundation. So thanks all. See you. Bye.
Bye-bye.